On the 13th of June, this is the week of June 13th through the 17th. Let's begin with the risk disclaimer. We understand there's risk in trading. Please and always use trade capital only. Do not trade with money we cannot afford to lose. Doesn't matter what you're trading. We know there's risk. We can probably feel it. We're probably hearing about it in the news. So trade accordingly. All right. If you're following me out there on social media, make sure you're following the real me. I'm not sending direct messages, soliciting any crap like that. Please report and flag and kick out any of those scammers out there on social media. But if you're following me, youtube.com/Chris Pulver. Appreciate the likes and subscribes. Everything else is pretty much real Chris Pulver. That's it. All right. Here are the charts. Happy Monday. Nice to see everybody. Let's take a look at the currency strength chart. We have a busy week ahead. Unless you're just not paying attention to anything in the financial markets, this week is going to be all eyes on Jerome Powell and the Fed with a rate decision that is now a complete mix because inflation printed Friday, CPI numbers right after the ECB, perfect timing to print, again, higher inflation levels. Here is the latest print. If we go to inflation rate by country, G20, and go to the last print, the U.S. is still sticky at 8.6% inflation. Most of the European Union still sticky, 8.1%. UK 9%. So banks are raising rates. Australia raised rates last week. They're looking at 5.1. So anyway, CPI printed higher, and of course has the whole markets worried. If you're paying attention to anything in the stock market last week, another big flush down Thursday, Friday, and today's opening on E-mini futures is right back down to the lows. Pre-market on the SPY is right back down to the lows. So we're looking to revisit that 20+% correction. Markets for the year. I'm going to chime in on YouTube here and say hi to everybody. Markets for the year, NASDAQ down 27.52. This is as of last week's close. So as of Friday's close. 27.52 in the red on the NASDAQ. S&P down 18.16. We felt so great after the month of May when it was, we tapped that 20% level and we finished the month of May like 13% down, like a sigh of relief. And here we are back to 18, and here we are gapping lower to retest that 20% level. We'll take a look at the charts because, look, we stay at this pace and the market is so scared with so much bearish sentiment. Seems like a falling knife. There's not a lot of places to go. This could have, the similarities to what we saw back in April where nothing is safe. Risk appetite is completely deteriorated. Bonds, I saw the 10 years up to 3.17, 3.2%. And that, again, could be like that forced hand where fixed income is looking just to park money, be safer at a 3% yield and just say, look, I'll tolerate inflation. But they don't want to see the ebbs and flows and drops in their portfolios. So S&P is down. We're looking to tap that 20% level today to the downside. Dow is down 13.61 as of last week's close. 10-year, like I said, up above 3%, which puts the Fed in a bind, in a pickle, because that's actually, for the 10-year note, that's kind of above the line in the sand. It's tough to service debt, which we have a global debt problem. It's tough to service debt at 3+%, especially in the U.S. That's going to force a lot of fixed incomers to exit riskier assets and jump into something safer like bonds. So we'll take a look at those in a moment. Crypto. I mean, one can say collapsed over the weekend, but it kind of did. I mean, I had chart alarms going off on Ethereum at 1,300, 1,200, 1,100, I believe. Bitcoin is down to 23K, I think. Maybe I'm wrong, and maybe I'm making all this stuff up. I don't think so. Let's take a look. Bitcoin's at 23,585. So we are through the May low, and in a way, kind of no end in sight for right now. Now, again, look left on your chart on Bitcoin, look left on your chart on Ethereum, and if there's any technical support, I'm sure a lot of traders are looking at this level from 2017 when we peaked around $17,000, $18,000. 20,000 is kind of that big round number. Price feeds were varying at the time, so it didn't quite hit 20K, but that is a big psychological level for Bitcoin. With the last 3-4 days to the downside, it doesn't surprise me that we did take out that low with momentum, and 20K is probably a very real thing. Now, I've said this for the last couple of months as we've stayed on the left-hand side of the trend line. Okay, left-hand side of the trend line versus right-hand side of the trend line. Did I add another little chunk at 25? Yes, I did. I added another chunk of $25,000, and I'm going to add more at $20,000. I also think that what I'm adding, this is small trades, right? These are dollar cost average levels, left side of the trend line. I'm going to get more aggressive with confirmation on the right-hand side of the trend line, which has yet to confirm. So once we have some confirmation, wherever that is, if we start to put in some lows like we did back in May, put another one in, we'll start looking at some technicals this week in the flex trading room. How are we doing on the oversold condition? Are we looking at some divergence? We might have it right here. You can kind of see it. We have low in price. We have a lower low in price that hasn't stopped yet. We are looking for some slight hidden divergence on the momentum indicator. If we come back down to relative strength lows as well, get into oversold territory, looking for some hidden bullish divergence. But again, falling knife, risk off. Crypto's on the left-hand side of the trend line. It's still risk assets, right? If you're not comfortable risking anything in crypto, don't be in crypto. But if you are, I like the technical levels. I like dollar cost averaging in. Some risk off flows are actually good, especially if you're a currency trader, because it is hopefully going to help us make some money on the Japanese yen, which is a very imbalanced currency pair for the last couple of weeks. So CAD yen short, Swiss yen short, Aussie yen short, looking pretty promising. Pound yen short, looking pretty promising. Here's the TNX. 10-year notes at 3.26%. Weekly chart. I also want to show one more thing. We're right back up to the same highs from 2018. This is October 2018. We're back up to the same highs. Now, what would be interesting, and I don't know if the chart's going to behave like this, okay? But if there is a sign of a bullish pattern, a bullish crown, bullish head and shoulders, it would be interesting to see this area hold with some resistance, because we have these 2018 highs right here. We are right back at it around 3.2, 3.25%. Now, you can see all this previous left structure. So I am wondering, just from a technical side of things, if we have a left shoulder, head to neckline, and we actually see a pullback on the 10-year note. I don't know if that's the case. Okay, I mean, given the current environment, this thing might just run hot, 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 hot to the upside, and we might have nothing but bull flags. And there's there's certainly bigger problems ahead if the TNX does not slow down. Okay, but from a technical side, if we do pump the brakes and we stall here around 3.25 and drop back below 3%, I think that offers a little bit of relief, calms things down. And the reason I'm showing this is because this week is all about the Fed on Wednesday. So take a look. The news for this week, high impact news. Let's go high impact only. Fed should be high impact on Wednesday. So we have, that's last week. Let's go to this week. There we go. So producer price index on Tuesday, Monday, no high impact news, no medium impact news. Retail sales for the U.S., retail sales out of China. Lagarde speaking once again from last week's pretty odd movement in the Eurozone. Looking at raising rates starting in July, September, December. The market's looking at pricing in about 1.4. Is that right? Yeah, about 1.4, 1.5% by the end of the year for the Eurozone, which would be really aggressive. I mean, that would be raising rates aggressively for the next 6 months, which maybe they have to. I mean, the Fed's raising rates. They look at raise rates. I'll show you that CME watch tool in just a moment, but it's right here. Okay, forecast 1.5, and we're currently sitting at 1. Okay, so according to this economic calendar, it's looking for a 50 basis points hike from the Fed. So not the surprise 75 basis points hike, but here's what the CME watch tool is looking at. This looks different than last week, and this has been a recurring problem for the Fed. This is what keeps the market on its toes and keeps the market dancing with uncertainty, because the markets don't know how to price in the Fed, right? Is it 75 basis points, which Jerome Powell explicitly said was off the table? And here we are staring at it again like it's a possibility, 40%, right? 39.1% probability that, hey, maybe they do raise rates 75 basis points, which has very little impact on true inflation. It really does. I read an interesting article this morning on the Fed and all the regulations and policies from the 1980s, where, is it who was our notorious fearless Fed leader Volcker back in the 80s, who raised rates to 17%, crashed the economy, stuck to his principles, but was touted as like the man that gave decades of prosperity. But there were also so many policy administrative decisions going into that 80s period that it just became like another decision made. So it's a combination of fiscal and monetary policy that are combined. So all eyes on the Fed this week. They cannot single-handedly change everything. They cannot single-handedly fix everything. And if we think that, we're really stupid. So this is what's confusing the markets this year. Powell's come in saying 75 basis points not on the table, and the market kind of cools out, thinking like, all right, good, let's 50 basis points, we can price it in. So what I'm going to look for, and I had this last week. Let me see if I can still find the expected Fed funds rate. That was a heat map from last week. Let me see if I can find it in here. Here it is. Okay, if you can see this image, I talked about this last week in the trading rooms. So another thing that really confused the markets this year was the aggressive change to market expectations. So in green, market expectations, you can see how dramatically that jumped up. So coming into 2022, the market expected the Fed to be around 0.9 to 1%. They knew there was going to be a tightening cycle. They knew the Fed was going to raise rates, but it'd be spaced out over the quarters, 25 basis points a quarter, slowly get into raising rates. And that would put the Fed around 1% for the end of the year, between 0.75 and 1%. Well, clearly that changed like day one of 2022, and the market immediately tried to price in a 3x more expectation. So now the Fed fund rate is sitting expected to be by the end of the year around 2.75 to 2.9%, somewhere in that window. That is where the market had that overreaction. We had that awful April slide, and it again feels like the Fed and the uncertainty of how aggressive they're going to raise rates again this week on Wednesday. Where does that put the expectations for the year? Where does that put the year-end estimates? Where does that put the long-run projection? Because right now you can see that it comes to a screeching halt, sub 3%. So it's interesting that the 10-year note is above 3%, right? And if it stays above 3%, that is not a good thing for risk assets. That is not a good thing for the stock market. That is a flee to safety despite 40-year plus inflation. And that's globally, pretty much. So anyway, it continues to be a really, tricky thing to navigate. And, this week I have a ton of expirations this week. So here are notes we'll be talking about this week in Equities on Demand. A lot of it's going to be tons of covered calls, some credit spreads. We'll talk about them. I might take some assignment on a couple. It will mostly be material plays. I am in some China tech stocks as well. We talked about those last week. I will probably take some losses on stocks that I don't really want to own. I'm trying to lower my costs on a bunch of things, and that might be it. I mean, Coinbase, I was kind of excited that I could lose Coinbase at $60, and because crypto just crashed over the weekend, Coinbase is now, and it's not open yet, but it's pre-market's around $50, and I have a cover call at 60. So we're trading pre-market 46.9, and we have our lows that are sub 40. So looks like I might be hanging on to Coinbase a little bit longer, and that's kind of annoying because I thought I was in a pretty good position to keep that covered call at $60 and get it called away, but alas, not the case. Now that could change, maybe it changes, but I would not be surprised if with the plummet of Bitcoin breaking new lows, Ethereum testing and breaking new lows, Coinbase is probably coming to retest this level back here from May. Pre-market, we're already looking to test it. It looks very similar to what we saw this morning on the E-mini futures, which was down to the lows. This chart alarm is about to activate, pushing us into some fresh lows. SPY, before the open in 15 minutes, we're looking at pre-market at 380, which is right down near the lows. So let's talk big levels so we get into some currencies. Okay, I'm not forgetting anything, and nice to see everybody this morning. So weekly time frame, pre-COVID highs, that's around a 30% correction. All right. This whole falling knife debate, we've had a pretty rough go the last 3 days. I mean, tons of volume in the markets to the downside. Thursday last week broke this little 7-day range. Friday last week continued to push higher. Inflation print on Friday was a big surprise. Well, not surprise, but it was a big red flag to the market, and selling ensued really aggressively. So here we are, like, how bad does it get? Well, we're at that 38% retracement. We're at that 20% correction off the highs. Is that a line in the sand for the bulls to come in here and continue to defend? Or, this is a weekly time frame, one indicator that might be some support is right here. This is a 200 exponential moving average, right? How many of you have heard of like the golden cross or the death cross, the 50 and the 200? We still have a long ways to go for the 50 period to cross over the 200 period. But what we are trading in right now is inside of that indecision window. So the bears are in control right now, but that 200 EMA may offer some support. Again, we might not flash. I was going to say we might spike and wick down to this level to find some major past resistance becoming support, which would be right around 340 on the SPY, which is a pre-COVID high. But again, I'm looking to see, is there a technical bounce off that 200? Do we stay inside this with a lot of volatility? We could trade from the 200 back to the 50 with a ton of volatility and see how this ends up, playing out. It might take time. I mean, by the way, it's June. It's not like this is, October, November, December with these, major impactful volatility decisions and pushes and trends really take shape. Like we typically see, this is a high volatility summer thus far, but we don't really see, breakout trends and stuff like that. So we're gonna, again, it's a lot of wait and see. It's a lot of buckle up, protect your butts, put on your safety hat, and get ready to do whatever you can to lower the cost in anything in your portfolio. Trade currencies aggressively and take profits when you can. And that's probably the best rule of thumb this year is when you have profits, eliminate risk, let those profits run, protect profits regularly, and chip away. I mean, anything I'm doing right now to actively take profit is essentially to offset any bad trades or wash any bad trades or reduce some of the size of my drawdowns. And eventually, like, I'll work through those trades and the profits will take over and shine through. And it's just it's a lot of battling this year. But I have a lot of hedging, which is great because it feels like I've got some winners in addition to managing some losers that I'm okay with. So I just continue to manage. But it's been a wild year so far, and it's probably not going to get any easier, right? So that is why we trade it. That's what we do. All right, what's going on here? Daniel, you're in 3 pound yen trades. Good. So sounds like you're up net. 92 on one, you're down, but 216 and 532 on the other ones. Excellent. We have some pivots and targets to go back to as well. Yes. I'm in a few good positions on CAD yen that I'm looking to take some profit at. I'm watching this one closely for, today, tomorrow. I'm going to look at that past level on the CAD yen. Let's take a look at those yen crosses. So currency strength really quickly. So JPY is up top, dollar starting to retreat a little bit. We have the pound, the Aussie, New Zealand, the CAD is in the middle. Euro Swiss still kind of pegged together. I would like to see, we'll take a look at oil here in just a moment. I'd like to see the CAD, if possible. Let's see if the CAD can drop back down here with the Aussie, New Zealand today. So that being said, let's look at, so the one thing you can see is you still see yen strength, right? JPY, pretty obvious. JPY is the strongest currency. Now, this is a good thing because technically this was desperately in need of a rebalancing. We saw 11, 12 candles in a row to the upside, bullish candles. The BOJ is stepping on the gas to continue to weaken their currency, but to the point where it's like, I really am looking at the charts thinking, all right, this chart is either technically broken, we're hitting monthly overbought levels, which we have not seen in literally 30 years. I'm like, either this chart is completely broken technically, or we're about to see some highs form. And it looks like the latter. Technically, the market is kind of behaving. The JPY is rebalancing, and I'm looking for some short-term equilibrium. So all these pairs I'm talking about, Aussie yen, CAD yen, New Zealand yen, pound yen, look pretty good for some shorts last week. So if you shorted anything, Wednesday, Thursday, Friday last weekend, yen crosses so far so good, paying out pretty nicely for some short-term profits. Right? Anything else? Dollar strong, so euro dollar's back down towards the 104 level. We're trading at 104.60. Pound US dollar is revisiting the lows at 2200. I'm still looking to see, now again, I'm long on pound dollar for these big historical levels. We had our flash crash low in 2020, which is around 1400. I am actually willing to build a position from current price down to COVID lows. So again, that's what I'm willing to do. I'm willing to build a small position scaling in over the next 500 to 600 pips to buy pound dollar and have this thing go back up towards 1.28 to 1.30. So I'm looking to build small positions over time. Maybe this trade takes 3 to 6 months. Maybe with higher volatility, it does what I need it to do, which might be falling and dollar cost averaging in, look for some confirmation. And then when I can get paid, maybe I get paid faster with higher volatility. We'll find out. Okay. But I do want to take a look at dollar index. Okay. And also, so dollar index, we'll look at the DXY as well. Dollar index is up to some fresh highs, but not breaking these COVID highs back in March 2020. The DXY is revisiting highs, and we have these equal resistance levels from 2016 and 2020. Now, the DXY is up above those levels. So does that mean that we're breaking to go to new highs? This is what I keep looking at for this week. We are at these highs. We have some equal highs in momentum. We have overbought conditions with divergence. all I'm saying from a technical side in this dollar index is it's hard for me to justify buying dollar right now, right? If I'm selling euro dollar, I'm selling, eliminating risk and trying to protect any running profits. But it's hard to, if you're selling euro dollar, you have to be telling yourself it's going to parity. That's about the only legitimate target that's out in the distance. Otherwise, you're selling into the recent lows. Pound US dollar, you're selling into the recent lows. Now, I understand that this doesn't have to be the top, but with the Fed this week, this thing could run hot Monday, Tuesday, Wednesday, and the Fed can completely reverse this and backpedal this, and we put in more of a near-term high on the dollar index. I don't know, right? Obviously, the Fed, what's it trying to do? The Fed probably can't step in and say, we're going to reassure the markets everything's fine. The Fed probably will not raise rates 75 basis points. All right, probability says 61% it's going to be a 50 basis points hike. That's what Jerome Powell said. If he backpedals and goes to 75 basis points, I think we're going to see, again, another very aggressive leg lower in the stock market. So that means that the Fed's reassurance of 75 basis points is off the table. If they raise rates this week 75 basis points, it's like the Fed does whatever it wants, and the market is having a heck of a time understanding and knowing what they're going to do. And that's usually what the Fed is very good at, is they will drip that information months in advance, and they will jawbone their monetary policy to the market so they can be priced in. So I do not think, and again, my opinion, so take it for what it is, but I do not think that the Fed is going to raise more than 50 basis points. What they will continue to stay is probably the same thing they've been saying, which is 50 basis points this month, probably next month, and they're going to reassess. You notice how there's no August rate decision? So if we can see this month 50 basis points, next month's 50 basis points, that's going to put us up around 1.75 to 2%. Okay? Let's say that we can start seeing the data points of the labor market softening a little bit and prices coming down, inflation metrics. Again, you look at all this stuff, like there's crazy. I mean, it's awful, right? And of course, it's like weighted inflation, not including food and energy, which is the worst measurement because obviously that's what hits us the hardest. As a consumer, that's what we feel the most. But if these numbers start to go down and the trend is starting to go lower, then I suppose that's the Fed doing its job. But it's like the one tool that they have right now, and the market doesn't know how to digest it when they keep changing the expectations. So, like I said, I don't think they're going to raise rates more than 50 basis points this week, and they'll probably talk about it, doing it again in July, and then assessing where things are at. Data sensitive, right? Maybe that's a good thing for the market this week. I don't know. We'll find out on Wednesday. All right. In fact, if you're interested, and you can tell me yes or no if you're interested, if you'd like to join me on, you want to do a bonus session on Wednesday, 2 p.m.? I'll just open it up. I'll do a YouTube stream. We'll do a special FOMC session and just be live for like maybe 30 minutes to 45 minutes. So if you're hearing that, type it in the chat. If you want to do a bonus session, I can schedule that and get it on the channel, youtube.com/Chris Pulver, and stream it like I do here. So, but I mean, it's a big one, and it's kind of annoying that it's always so important, but we'll watch. Okay, yep, so we'll do that. All right, I'll do that on Wednesday. That's fine. Anything else? DXY, yes, let's take a look at oil. So oil is at 119.67. Let me go to the daily time frame here. We have still not yet seen a break of any of these lows. So higher lows, higher lows, higher lows, higher lows, higher lows, higher lows. I realize that this level, oops, that's not what I wanted to use. Hang on. I realize that that level at around 128, mattered from that peak back in March. I know that in the interim, with some supply and demand for the summer, high to low, equal high to equal low, we could have a range coming on oil. The one thing that makes me a little iffy on that whole idea is that if this resistance doesn't hold, I'm not drawing that very well. If this resistance does not hold, I think a lot of that has to do with China's reopening. China's reopening can increase a lot of demand. That's very difficult for supply to keep up with. That increase in demand is going to keep increasing prices. This increase in prices, if we break through 130, there's not much stopping oil to 147. We break through 147 to 150, there's not much stopping it to infinity. So this idea of an energy crisis, this idea of $200 a barrel, this idea of $250 a barrel can certainly happen. Right now, there are ways to pull that back in place. There are, OPEC agreements There's more special petroleum reserves from countries around the world, mainly the U.S. There are some, peace talks, I suppose, coming out of Russia, Ukraine, if that happens, which it probably won't. But there are factors that could play into stalling the trajectory right now of oil. I don't see that really happening. I do see that technically speaking, from 128 to 130, we could see oil stall, right? I don't see oil going back down to dramatically lower levels. I could see oil stalling at 130, 128, coming back down to let's say 100 to 95. But from there, probably remains well supported, remains elevated, and demand remains high. So I just think higher energy prices, higher commodities. If you're positioned that way for your portfolio this year, that's probably a wise thing. I did catch a let me see if let me find this picture here. Here's one way to look at it. So just having some fun, but this is one way to look at it. Okay. Hashtag oil, energy stocks. Look, if you're in energy stocks, that might be all you need in 2022. You want to post some decent gains. Energy stocks, commodities, materials performing pretty well. Energy stocks performing extremely well. Everything else tech-wise, you can pile them all up and just watch them fall. It's like the dust is going to have to settle on tech. The dust is going to have to settle on pretty much everything to figure out. We've had a decade-long plus bull market, right? Long in the tooth. We stretched a bull market for 13 to 14 years. So a rebalancing, a pullback is completely normal. It's just funny how, a 20% correction is like the world is ending. Look at how many bad things have to be happening right now for the stock market to drop. That's why it's heavily manipulated and it sucks. It's not a free market stock market. It is artificially engineered. It's been propped up by the Fed put, and it's like really frustrating to see that in order for a correction to happen, you have to have all these terrible things going on in the world. And those terrible things have consequences, and we're trying to navigate that all right now. Coin is trading. I know it is. We talked about that first thing. Coinbase is way down. Everything's way down, right? 46.4. I've got a chart alarm set at the lows on Coinbase. Crypto's been hit pretty hard. Bitcoin is trading at 23 and change. Yeah, we're 23,399. We're down. What am I showing today? 12% down in the day. And by the way, just putting Coinbase in perspective here, for the last how many days in a row? 1, 2, 3, 4, 5, 6, 7 days in a row. We have probably watched, that is another 26% to the downside on Coinbase. And from a market cap side, okay, if you type in total, we went from, wow, this is crazy. 2 months ago, just over 2 months ago, we were back up to $2.1 trillion in market cap on crypto. This is total crypto market cap. We are now below $1 trillion. Man, I mean, just not a lot of things are pointing to positive crypto right now. That has been a 56% wipe of market cap. So, I mean, look, this looks a lot like any tech stock. If you looked at, Shopify, Peloton, maybe not so much, maybe a little bit of Netflix, not as ugly and gappy, but man, it's violent, right? It is violent. So hold on to your butts. Things are going to get nuts. I didn't mean to rhyme, but let's have some fun with it. How much faith would you put into that? Put into what? Just market in general? Look, this is what I think. I think what this is if there's any future optimism in Bitcoin, which I think there is, okay? I'm still like pro Bitcoin, I'm still pro decentralized currency, I'm still pro blockchain, I'm pro Web 3.0. Like it is innovation, okay? Crossing lows, 9:30, Wall Street's open. We're going to have chart alarms like crazy. Equities on Demand students, get ready for a busy session today. We're going to talk about some puts. We might have to do nothing because all these things could get way, way worse, right? So we're going to assess to see what's really important. Is it really worth taking assignment? Sorry, if you can hear my screen. Did you hear that, by the way? Did you hear all that bells and whistles? You probably did. Super annoying. But what I was going to say is, we have expirations out to Friday. And it might be really interesting, like today, to be like, let's start taking long puts. If this gets worse, all we're doing now is taking profit on long puts, which is great. And we would calculate our break even and we could just watch price continue to fall. So if it gets worse, I'd rather have those expirations still out there and those long puts still running and try to go, tick for tick, dollar for dollar with every bit of the bearish move this week. Because if it's bearish today and it's bearish on Tuesday and it's bearish going into the Fed rate decision on Wednesday, there should be no rush for us to jump in and start, taking assignment. Because what I'd like to make sure that I have is a ton of margin to trade and a ton of cash to trade. And even if we decide this week that this is not the week to take a bunch of assignments and throw away a bunch of capital at stocks that are all getting beat up so badly, maybe that's the better decision this week is just take losses. We'll get some covered calls. We'll lower our costs on some of those, and we'll reissue more covered calls. We'll assess our new break evens and just keep trading. But I want to take assignment on, what I think is going to be the safest play that I'm willing to build and have some decent premiums on moving forward. Not on stocks I'm like, well, now we're upside down $5 or $10 a share. It's going to take a while to build that back. That's what I don't want to deal with. Okay. How about new long puts? Yes, but it's like this is what's been so tough about this week, or like it's like the puts should have really started in November, December of last year. The puts should have been started in January of this year. They should have been started in April. It's like, so to talk about puts now, to talk maybe bear call spreads. If you're in options, maybe bear call spreads, because at least you have a chance to say, look, if price can't go back up above that sell call level, then sure, we'll make a little bit income, but sell the premium, you know. But I just think like doing long puts now, it's like it might be expensive, it might be limited downside, and I mean, we're at lows already. We're at like these massive corrections. I mean, stocks have been 30, 40, 50%, indices down 20+%. So it's hard to justify now like wanting to get short on stocks that are already 70, 80% down. So I would just rather assess everything, have cash margin available. And if I take losses this week in equities on demand, that's okay. That might be a smart decision to have cash at the ready, always have dry powder, because you know what? If there's a better discount, a better opportunity, I'd rather have the cash to do it and buy something or, trade something. So anyway, again, that's why we have all the time together every single week in equities on demand to make those decisions. So we are going to have a busy week. I went through all my accounts from A to Z, all my covered calls and my credit spreads, all these things I have expirations on for this week and beyond. We rolled a couple credit spreads and covered calls last week. So again, busy session, busy week, which we knew. Okay. All right. Anything else for today? I know there's a lot to talk about. Here's what's going to happen. So if you're interested, so we have our Monday session. Okay, Monday. Check. We're done. Wednesday. Here's what I'm going to do. At 2 p.m. Eastern Time, we'll do a live session. All right. I just want to do a live FOMC session. If you're interested, come in, check it out. We're going to see what the rate decision is. It's at 2 p.m. The press conference starts at 2:30 with Jerome Powell. If they raise 50 basis points, that's what's expected, right? Maybe that gives the market a little bit of optimism. I don't know. But we might be bearish today, bearish tomorrow, bearish going into the FOMC. And if you want to watch, here's the Fed watch tool. Watch this to see if these percentages change over the next 24 to 48 hours. So take a look at this. Okay, if you keep an eye on this tool, if this 150 to 175, that's our expected target rate, if this increases in probability, this shows the market is even more confused on what the Fed is actually going to do. So I wouldn't be surprised as we get into Wednesday, this is probably going to be higher. This is probably going to be lower. The more uncertainty we have, if this is 50-50, the stock market will probably be much lower than it is right now. We'll have another aggressive day or two of selling. But you have to remember, it was last month that the Fed raised rates 50 basis points, and they completely removed 75 basis points from the commentary was like, we're not even considering 75 basis points. But here it is, the market's like, I don't know, never say never. So we have to watch this. All right, so that's one thing you check out. So on Wednesday, I'll do a live FOMC session, and then I do have some family coming into town on Thursday and Friday. So Friday, I haven't decided yet. I do have a scheduled live session for us, but I might just post a recap video. So right now, because I know family's coming into town regardless, it's going to be a busy week for me trading wise. I'm not watching my stuff. Like, I'm still trading, but with family in town, I'm going to probably do videos versus live sessions and save myself a couple of hours so I can see family I haven't seen in about a decade, and that's no joke. So Friday, probably a weekly recap video. So I'll post that on my respective social media outlets. I mean, you'll find it on Facebook. You'll find it on youtube.com/Chris Pulver channel. Um, I'll have it. It'll post on Twitter as well. You know, all the stuff that I do this restream on. So probably a video, maybe. Maybe I'll do a live session, but I doubt it. I'd rather just do a video Thursday night and assess everything. Traders in my equities on demand trading room. If we don't have a live session on Friday, we're still going to do Telegram updates. I'll still be managing all expirations. Our job, like we said last week, is to assess the week as a whole. 6/17 expiration, I know we have a lot of them. But if the best decision this week is, look, let's take a 50-cent loss on a credit spread, who cares? I would rather do that than take ownership of stock, deplete all my cash, and then, have nothing to work with. So if we end up having a losing week in stocks because of that, that's fine. If we have, and believe me, we're gonna have some stocks we're gonna take ownership of. I'm ready for that. So if it's an Alcoa, if it's a Cleveland Cliffs, if it's an X, if it's, I mean, even a, I'm trying to think what else, like a Kraft Heinz, International Paper, any of these like defensive stocks. If it's a financial stock, if we buy lower, we've talked about HBAN, we've talked about ONB. There will be stocks we're interested in, but everything seems pretty toxic right now. And this has the same kind of feeling like if you're frustrated from April, frustrated from the early sell-off in May, there's not a lot of safe places to hide when everything is in the red. When you're looking at a heat map, and I'll wrap things up here. When you're looking at a heat map and this is what the stock market feels like, again, there's a saying, I believe it's Buffett's quote, like buy when others are fearful. I mean, yeah, there's a lot of fear in the market. This has been some of the lowest sentiment we have seen in like ever, like almost on record, like the lowest confidence, consumer sentiment, which for the US sounds pretty terrible when 70% of your GDP is consumerism. So we're going to see if it's a demand problem or if it's a supply problem. Right now, we haven't had demand really change a lot. People still want to travel and spend, then that might be good. But right now the markets are, shaken and rattled to the core. We're going to figure out what the Fed's going to do this week. So that's why I'll have an extra live session. And that's why I don't feel bad if we're not live on Friday. We did a bonus session on Wednesday. All right. Yeah, so Dennis, the link is just come back to the channel, man. Come back to this channel that you're on right now, youtube.com/Chris Pulver. When I go live, you'll see it pop up, right? So when I'm live and I push that at 2 p.m., you should just come to my channel. It'll pop up with a live icon. You can jump in and join us like you did today. Good stuff? All right. So I want to take a look really quickly at the TNX and the TLT. So we have the 10-year note, which is at 3.28, so it continues to stay elevated. The TLT is the 20-year treasury, right? We're at 111. So even though we see 10-year notes trickling higher, we're still seeing bond prices going lower. It's just a really messed up environment. And in addition to that, you have higher inflation. So we know things are really ugly, right? We know things are ugly. We know things are bad. It just seems to be getting worse. So all I'm saying is, if you're trading, you got to trade through it. We got to trade through it. Sometimes it's okay taking losses. Here we are, this E-mini futures, we're right back down to the lows. Do we close below these lows today? Amateurs open, pros close. We have 3 straight days, Thursday, Friday, and today, all bearish. It might stay this way for today until there's some maybe reprieve or some relief if the market takes anything the Fed says on Wednesday with some optimism. But they've talked about, Fed navigating a soft landing is going to be extremely difficult. And it's true. It is going to be extremely difficult. And you look left on your charts, I just need you to understand that there's nothing about this resistance right here that means the market has to stop, right? We can flush all the way down to that past resistance and keep going. We could flush all the way down and take out the COVID low and keep going. There is nothing that has to be rational about this fall. And I think this is also what makes it so challenging is we're trying to put our brain around like, well, it's got to bounce there. That's past resistance becoming support. It doesn't have to do anything. Right now, it is whatever you're positioning for. If you have profits, eliminate risk, protect your profits. If you're in upside down positions, hopefully you can lower your cost basis, take good trades and profits, wash away the bad, and keep that risk off the table. And right now it's like it's a good thing to be risk averse. It's a good thing to be, on the side of where the markets are going. So we can see that in currencies. I mean, if you're a Forex trader, you're loving this right now because there's good volatility to make some money, right? Great volatility to make some money. So that's what we want. If you're in stocks, look, like Lewis said, couldn't we just do this? Well, yes. 3 months ago, I'd be thinking about it. 6 months ago, it would have been much better timing. But it was like a landslide in April where I had a great Q1 and April sell-off just kind of dragged everything with it. But I was in positions for energy, for commodities. I still like those trades. If you're in some of these, we're in DBC, performing extremely well at highs. Okay, we're in Halliburton, performing extremely well off of highs. This one has a pullback recently. BKR had a pullback last week, but we're at highs. CPE, LPI, CLF. I mean, we have tons of stocks that we're in that we're going to continue to watch. Now, these are stocks that I don't mind owning. They're not that expensive. And this is the stuff we'll talk about and assess this week in EOD. But I don't want to just start taking profit on long puts now, because if it gets worse today and sells off with like a horrible day, if it's a 2.5%, 3% slide, like right now, the SPY's at 2.62% down, E-mini futures at 2.3. If we have a 3+% sell off today, bring it on. So I say head on a swivel, eyes open, focus on your levels, watch your profits if you have any, or watch your drawdowns if you're managing them, and make sure you have cash and margin at the ready. That's going to be the most important thing for today and this week. All eyes on the Fed. It's annoying, but it keeps happening. They're the most important people in the room this week. The Fed is frustratingly taking all of the attention, and there's no, misdirection other than maybe watching oil prices. All eyes on the Fed, all eyes on oil prices, and we'll see where the dust settles. 10-year notes above 3%. That's not a good thing for the stock market. Okay, Fed's trying to navigate this soft landing, which might be nearly impossible. So we have to consider that stuff. All right, traders, here's the deal. If you're with me this week in Flex Room, if you're with me this week in Equities on Demand, let's have the best week we possibly can, right? We're here to trade. We're not here to complain. Let's do our best. Wednesday, I'll have a bonus session at 2 p.m. Come back to the YouTube channel. Come back and watch on the stream. And we'll come back at 2 o'clock and see what the Fed's up to. All right? So we'll do our best. Let's have a good trading week. See you soon. Happy trading. Lots of profits. Thanks, everybody. If you do me a favor, for everyone tuning in today, hit that thumbs up button for me. Like the channel, support it. Helps a lot to help the little algorithm for YouTube to get this, throw it out there to get other people in it. We're almost to 5,000 subscribers from starting from 0 last year, so I appreciate that. We get a few more in there. We'll celebrate the 5K mark, and then hopefully onwards and upwards. All right, buddy. See you in the trading rooms this week. See you on Wednesday for the bonus session. Thanks. Bye.